All right, YouTube, stocks by the numbers, back in action. Let's get into it. Name of the company, Fiverr International, ticker symbol FVRR, listed here on the New York Stock Exchange. $29.22 a share, down 67 cents, roughly 2.25%. Let's see what's going on. Now, this company, as many of you know, runs the website. You find people to edit your videos or whatever you need them to do. You pay them $5, $10, $20. Boom, there you go. Everybody wins. Obviously, a lot of younger people are making accounts and getting on Fiverr, trying to do what they can do to earn and generate some income. And we do have revenue consistently increasing year over year, so I do like the stock on paper already. We have a market cap of $1.1 billion. The company 4 quarters in a row, the last 4 quarters coming in above estimates on the EPS side, and you can see revenue just beautifully growing, 75 million to north of 100, almost 200, almost 300, then up about 10-12% here, 337 million for the year. Profit margin as well seems to be consistently increasing, so that is a pretty good sign. Switching over here quarterly, we can see that Q1, which was just reported at almost 88 million, company fighting to go net income positive here in the last couple of quarters, but we can see again going back 1 year ago, about 1.3 million less. The company brought in 86.69 million, but they lost 17 million, so bringing in about a million more in change than this time last year, but instead of losing 17 million, the company only lost 4 million. And you can see the previous quarter profit margin minus 1.5%. So the company is really fighting, and this could happen soon. And of course, when the company turns from net income negative to net income positive, that is going to give it a serious boost in stock price. So again, could this be the perfect price right here at $29.22? I mean, probably not. We could probably get it for a couple of dollars cheaper, but at the end of the day, I'd say to really position yourself into this stock at like less than maybe like 30 or even like the mid 30s here. It's probably going to work out for you in the long run if the company continues doing what they're doing, right? Let's look at the numbers real quick. Coming over here, we see revenue consistently increasing. Cost of goods is basically up more than double since where it was in 2020. However, revenue has almost doubled as well. 189 million, now it's up to 337 million. Gross profit consistently increases because total revenue minus cost of goods sold is gross profit. Operating expenses are outweighing gross profit. So this is why the company has been struggling, as you see here, going all the way back to 2017. It has always been this way. However, it has been shrinking. It really has been shrinking. Obviously, it had a big jump here in 21, and it looks like a difference of 46 million. And here, it's a difference of about 42 million. But as of right now, it's showing a difference of less than 37 million. So if this is slowly trending in the right direction, again, year over year, it might take a while, but it eventually will happen. And again, the service that they bring to the table, chances are, in my opinion, the revenue probably will consistently keep increasing because I'm sure, only more and more people will end up making Fiverr accounts to generate a few bucks for themselves and their families, right? So chances are it's not going to go down, or it really shouldn't, but obviously only time will tell. But looking here annually, you can see assets took a big jump here post-pandemic, almost hitting $1 billion right now. As of last year, sitting at about 920 million. Liabilities obviously took a massive jump as well going into 20 and 21, but sitting here at about 650 million. So it's about a 3-to-2 ratio, but as long as assets are outweighing liabilities, I guess it's nothing too crazy to be concerned about. The debt really exploded, as we see here, going from just several million up to 370 plus million, and then just slowly climbing 387, 462 million. So, obviously there are some positives, there are some negatives here. Book value per share dropped down here since 2020 highs of 964 a share, since dropped down to 708 a share. And basically that's because the equity has decreased, as you see here. Was 345, 346. The company was maintaining this 9+ book value. Then it takes, as you see here, 20+% hit in 2022, and so did the stock. It followed. So, again, we have some positives, we have some negatives here. We got some cash. Cash from investing has been decreasing nicely. Got a couple million from financing. Okay, cash flow. We have no PE because we have a negative EPS, which is the earnings per share, and the PE ratio is the price of the stock to the earnings per share. That's where that number comes from. Price to sales, down here at about 3 1/3, was higher, was slightly lower, but as of last year, the lowest it's been. Price to cash flow, lowest it's been. Price to book, lowest it's been. And interestingly enough, I don't know if I've ever seen this, the enterprise value, supposedly what another company would pay for this company, 1.1 billion, market cap, 1.1 billion. But again, we have some positives, we do have some negatives. The return on assets was sub -3%, outside -6%, nothing too crazy. The return on equity was lower, heading in the right direction. Return on invested capital. Look at the gross margin here, north of 81.25%. Back up, these were the main highs here back in 2020. And you can see that, it's only about a point and a quarter away from those highs. So the fact that the gross margin was down in the 70s, now it seems to be maintaining this 80 plus. And even after it dipped down sub 80, it rebounded even higher than 80. That, in my opinion, is a pretty good sign here. The operating margin, again, was as high as 15.5% looking back just the last 3 or 4 years, and has slowly come down 12.5%, now sitting at -8%. The EBITDA as well was -13% here. This is 20. Oh no, that's 21. So yeah, right. 2020 they had their best numbers, and again, moving forward, you can see it goes back to negative double digits, but slightly starts to pull back, -9.5, -6%. Net margin percentage again was almost -22%, moved to -21%. Now it's sitting supposedly around -5% right now, but however, I believe this is just for the first quarter on the books. But even if you extrapolate that, you would be looking at, like 19.3, -19.3%. So again, it would be a slight increase year over year. Asset turnover, as we see here, they were doing much more with their assets, even though it was decreasing. However, they seriously increased the assets, as we saw, going from 100 million, 200 million, now up to 900 plus million. And again, liabilities were sub 100 million. Now they're up to, north of 600 million. So, I guess coming off the good year, having the little dip, and then slightly increasing year over year, I guess it's a good sign. Company doesn't pay you any dividends. And look at the forecast here. This is what I like here. So apparently, the company reported 71 cents a share, which came in above annual estimates. And here for 2023, they're estimating $1.48 a share, which again is more than 100% increase from 22 to 23. So the company just is going to consistently keep increasing profitability moving forward, which is never really a bad sign. And apparently they're going to do it off of about a 9% increase in revenue, going from 337 million up to about 361.25 million for the year. So that's a good sign. And of course, estimates just consistently keep increasing. You can see they break into the 400 millions, and then into the 500 millions, and then into the 600 millions. So they are anticipating and forecasting much bigger and better things for Fiverr moving forward. That's why I'm saying if it does even slightly get in the ballpark of these profitability forecasts and these revenue predictions, then of course the stock value is going to follow suit. That's why I'm saying here, mid-2023, the stock's $29. Yeah, it's, 5 times, 7 times book value. No. Yeah, it's like 5 times book value. But at the end of the day, again, if the business itself and the revenue is going to be consistently growing down the road, then you will turn around more than likely mid-2024, early 2025, and the stock is going to be significantly higher than this $29 mark that it's currently sitting at. But looking at all these regions as well, you can see the increases, right? Consistent increases here in the States. We have increases overseas in Europe, Asia Pacific region, the rest of the world, and then Israel. Interestingly enough, apparently Israel is not part of the rest of the world, but either which way, the revenue has been increasing over there as well. Now you can see this was the high, really, date of inception back here, probably the first week or so. What is that? Yeah, it's a week. So 44.25, and then I kind of just drew that across, and you can see that it's a main level really of support and resistance of this stock. So if the company continues to do what it does, it's probably only a matter of time before this stock gets up to this 40 plus level here. And you can see some really nice returns here if you get in this stock down here in the 20s, obviously. But basically, big green arrow, this was, you guessed it, pandemic, stimulus money came in, kids bought a $20 stock and took it up to $336 a share, which of course was not real because it immediately gave it all back and came down to sub 30 where it was and has since been bouncing around. And again, you can see took a while to break through that level on the way down, and of course retested recently February of this year. But looking at like a 1-year chart here, you can see we're kind of in like this downward wedge here, but we've really just been kind of just bouncing around, just waiting. And you know, we could potentially line up and have a breakout here. That's why, you know, if you're looking at it like this, then you can say, well, you know, it just came down and broke the simple moving average, so it could come down and hit the bottom, you know, trend line here, come back down here around this level, like this 25.5 level, which incidentally is the 52-week low, 25.47. However, if it does pull back here, obviously it sucks if you're holding it, but if it does pull back here to that 25.5 level, guess what? You'll have a potential double bottom lining up, and if this wedge, you know, works out and is the correct pattern, then obviously you'll have a double bottom with the descending wedge, and you'll have a massive pop here. And then, of course, we have earnings around August 10th. So the company more than likely, well, again, could break out of this pattern and try to retest this line up here in the mid-30s. But chances are you could probably wait, I'd say, like 3 or 4 weeks before you buy this, because it's probably going to continue trending downward like it's been, or at least remain flat. And a month from now will be July 19th, which will be roughly 3 weeks or so before this company reports earnings. So hopefully you'll catch it, again, a couple of dollars less, in the 25s perhaps, in the 26s, and then we can position ourselves, catch the pop here back up to 28, 29, and then there'll be, again, hopefully a little rally maybe up to this fib maybe of 32.25. And then if the company does come out and post very nice profitability, look at that, 36 cents a share. That's what they just posted. So all they have to do is basically kind of just maintain their business again quarter over quarter. They just brought in touch below 88 million, and they're looking for 89.25 million. So it's doable. But again, it comes back to the company's earnings, because again, on looking at some metrics, you could say and make the argument that the stock is still overvalued and should continue to pull back and make new lows, right? So if that argument is also on the table, then if this company comes in here around mid-August with severely light numbers, really on either side, they could potentially punish the stock. But again, basically wait and see. And, you know, it all comes back to earnings, as much as people don't want to hear it. I know we all want to, you know, catch a pattern and try to see, you know, if we can time something right. Oh, look at the head and shoulders, look, you know, double top, double bottoms and whatnot. But, you know, at the end of the day, it comes back to the numbers. Again, you guys wanted to pump this stock up post-pandemic. Fantastic. I hope you all made a couple of bucks. However, as we see, it wasn't real because the business itself is nowhere near that valuation, so everyone just hit the sell button and everyone made money on the downside again. Now, you probably had some young kids out there, and not to beat them up, but, you know, I don't want to say I find it sad. You know, it just disappoints me because people I know either don't have the time to do research or feel that it's not necessary, and, you know, I'm sure there's people out there who bought this stock at these ridiculously inflated prices and are probably just sitting there saying, like, wow, it's going to take like 5 years to make this money back. Like, what's the problem here? But anyway, it does all come back to the numbers. And again, this quarter is going to be telling. But this blue trend line, if it bounced off of this after making this low, you can see it was very close to this trend line. And if we extrapolate the blue out a little bit, you can see that even if it doesn't pop out here and become, and turn extremely bullish here in the next couple of weeks, you can see that even if it rides this bottom trend line going into earnings, you're looking at like the high 25s, even 26. So that's why I'm saying now it's kind of towards the top of this wedge range here. So if this can pull back kind of to the mid of where it's been trading and pull back sub 27 right here, this fib 26.76, I would be a buyer, actually, in my opinion, down there at 26.76 right here at this fib. And listen, if it drops again, as we see, you got like a dollar downside, but then it's probably going to bounce and at least get back to that fib. So at least, going into the potential breakout and, of course, the potential rally going into earnings, at least you're going to be like kind of fairly valued, and you're not going to get beaten up too much on the stock if you become a holder going into earnings on August 10th, right? Switching over here to stock charts, we can see we're looking at the daily. The MACD has been rising. Obviously, the stock has been up since June. And you can see, looks like it's right near this 50-day moving average right now, sitting at 30.57. But you can see, going back here even, you can see the rejections off of the moving average, really, for several months now. So that's why I'm saying, this is basically going back to around the last earnings report. And that's why, again, it really all comes back to the numbers, as much as a lot of people may not want to hear it. It comes back to the actual business of the company. RSI sitting at 51.5. So again, we could run up. We could have a potential break. We'll have to keep an eye on it and see what the candles do. But again, it probably should pull back a little bit here, in my opinion, and kind of continue this downtrend. And hopefully the company posts those good numbers, and boom, you're going to have your breakout. But here the 50-day moving average, 33.55 here on the weekly. And you can see even when it slightly got above, it came back down right after, just within, the next couple of months. So the stock, as we see here, going all the way back to mid-21, selling off, look at this. Where is this? Up at the $200 level. That was the last time this stock was like consistently above its 50-day moving average on the weekly. So again, the company really has to put their money where their mouth is and report good, healthy numbers consistently increasing moving forward. And then the stock is going to break out into the 40s and potentially the 50s and whatnot. But again, I do think it's a buy, but I just don't want to buy it here at 29 and change, and then all of a sudden it's at 27, right? You don't want to immediately take a 7% haircut. But again, in the end, if you turn out right, then I guess it's okay. But again, we always talk about pricing and timing also on this channel. So why would I force my way in at 29.25 when I could potentially get in for 27.25, or this fib level right here of about 26.75, right? And we can position ourselves at a more fairer price going into earnings. And then, of course, again, if the numbers come in, above estimates, it'll be completely justified, and then the stock, of course, will probably start trending, and everyone will, it's going back to 200. But, here on Earth, in reality, we know, well, it can easily run up to this next trend line here of about, 35 and change. And, of course, we have our main resistance support level that we spoke about. Now you'll be looking at like 48 and change. And, again, that's probably going to take a couple of quarters for it to get back up there. It should anyway. But, again, if this company really comes out with good quarters, with good numbers, this quarter, the way it's been growing, you can definitely see the pop there into the 30s. And again, this was just from these highs here, right? This came off from high to high, and then I drew this from high to next high, and you can see that, that's basically, in my opinion, where the stock is going to go if the numbers. Why do I keep pulling that? If the numbers are above estimates, right? So here, right, let's say, boom, they report earnings. Oh, earnings are good. Yeah, see, about 35.25. So that, in my opinion, would be like my price target, right? And again, that's a short-term price target, because moving forward, if they consistently increase revenue and beat estimates, then it's only going to break above there and go into the high 30s and the low 40s and continue to run, right? But yeah, like safely, if I was an analyst, I would probably say that the stock could get to $35, by year end in the next 6 months, right? Within the next 2 quarters. Because again, even if they post a great quarter, and let's just say they break it up to like $42, you always have the potential that that next quarter may not be so high, and then they'll bring it back down to like $32, right? So not too bad if I say I think it's going to 35 and it ends up, going up only 10% and getting to 32. Not too bad. Could have been worse, right? Could have been worse. But hey, I'm gonna end it there because I don't have much else to say here about Fiverr. Um, like the video, thumbs up, helps out the algorithm, helps me get more eyes on the channel. Obviously, that means a lot to me. Subscribe to the channel. That's really all I ask. Again, that's basically our handshake agreement. You can leave in the comments section any stocks you want me to look at. I'll take a look at them, no problem. If you need help with anything, or if you want to learn about the markets or something, you can join the Discord again. And that's all I ask, really, is the handshake agreement. I'll keep making the videos. I just need you to hit that subscribe button. But basically, I just want to remind you, just because this is a younger tech company that, may have a little bit of name recognition with you, doesn't mean that it has to go higher. Doesn't always mean that it's definitely a buy. It doesn't necessarily mean in 2, 3, 5 years the company's still going to exist, right? But chances are, at the trends we've been seeing here, again, probably going to increase over the years, in my opinion, unless they really start doing some crappy business over there. And probably only a matter of time before they do go net income positive as well. So, again, that's why overall, in my opinion, I actually think it's a decent company with the way they're operating and handling themselves and what I'm seeing in a lot of the numbers. So, again, if I bought shares of Fiverr right now and you told me I had to wait, a couple of years, I probably wouldn't lose too much sleep over it, to tell you the truth. Probably wouldn't lose too much sleep over it. But, of course, anything can happen. The company could hit new lows and it could really suck. But, yeah, I'm going to end it there. So, stocks by the numbers again. Thanks for stopping by. Hope everyone had a good weekend, and we're going to get back into the market tomorrow. Thanks for stopping by. Have a good day.